Every week since 2007, we have put out a market carver. That is us carving the market, telling you what we think is most important to our allocation team. It is free to you. Go to yourlifeafterwork.com. Get signed up for the market carver. We'll happily share it with you. Our best thoughts, a summation of the market and the economy each and every week. Yourlifeafterwork.com. Get signed up for the market carver. What in the world is a tax bomb? Ed Slott's retirement tax bomb. I've been a part of the Ed Slott organization for the last 18 years. Hard for me to believe, where we study taxes. This is a recap of the retirement savings tax bomb. It's new, it's improved. Here's what's in it for you, and what you're going to get on this show is a discussion of an interview Ed had. So, my name's Joe Clark, for those of you who don't know. I'm a certified financial planner, and I was on Ed's board for more than 12 years and one of the founding members of the Ed Slott Elite IRA program. I get together, just got back with 400 of my closest friends. Actually, some of them have been on vacations with them many times. But it's tax attorneys, it's CPAs, it's other geeks like me who like to read tax code. And here's what we understand. There are some rules of life that don't change. Other ones are very, very fluid. For instance, you've probably heard by now that the tax code sunsets in 2025, and January 1st of 2026, it goes back to where it was in 2017. Now, if that's not confusing enough, what in the world does sunset mean? Well, every time Congress comes up with tax legislation, essentially the Congress and the Senate and the President have to sign off on it, and then the IRS has to say this is how we're going to implement it or employ it. So you've got the Ways and Means Committee that comes in, and it's a whole, you really don't want to know how the sausage is made is the bottom line, but there's a whole set of things. In order for a tax code to be permanent, it just means that those collective bodies have to agree to make a change, right? So they have to vote to make a change. I don't know about you, but I don't think people at 60 senators in Congress today could vote that the sky was blue or that I'm standing in a studio, for that matter. There's certainly something that they would argue about, right? So sunset, they have to vote to keep it in. Permanent, they have to vote to get it out. So unless you believe the tax code will have 60 senators who try to do something between now and the end of 2025, when I say do something, I mean agree collectively. And it's possible, believe me, it is possible. But if they don't agree, then it's going to sunset and it's going to go back to 2028, or back to 2017's tax code. So Ed, years ago, he's the number one contributor, if you will, to PBS. His shows have been out there many, many times. Ed Slott, you can go to IRAhelp.com. Great guy, good friend of mine, and we're on here. So he wrote a book called The New Retirement Savings Time Bomb. My book, which will eventually, before I die, come out, I promise, is called Retirement Runway. Both of them really are the conflicts of dealing with the IRS. Where many rules are fluid, the tax code changes all of the time. I would teach you how a tax number is created if it would be meaningful for you. But essentially, if there's more than 365, it means there was more than one tax code changed on average daily. That's the world we live in, by the way. So the first question is, what exactly is the tax time bomb, and how big of a threat is it to retirement savers? So here was his question. Taxes will be the single biggest factor that separates people from their retirement dreams. I put it this way. Nothing in 35 years of being in the financial services world have I ever seen that will separate you from your financial future like the Internal Revenue Service. Americans have invested trillions of dollars, that's not an exaggeration, in retirement plans, turning them into the biggest, most valuable asset they own. True, often more than even their home. I think we actually passed home value in 2003. The value of 401ks, if I remember. It was way before the housing crash in 2007 and 2008. It started in 2007. 8 and 9 was the Great Recession. But these accounts are also typically have a huge unpaid debt facing them. What you say? I've put money in. How could I have a debt? That's at a future tax rate upon distribution. So imagine this. You tell the kid that if they don't take the ice cream today, right, that they'll be able to have more ice cream in their future, but you don't discuss the size of the scoop, the flavor that they can get it, or how old they will be when they're able to get the ice cream. And that really is what the IRS does. They've changed the rules multiple times on the size of the scoop that the IRS takes in terms of taxes. They've changed the flavor, the way you can pull it out, and what else it does to your tax return in terms of making this more taxable or your Medicare more expensive, if you will. And they've changed the rules on when you have to take it out in the form of required minimum distributions. You would never negotiate that deal with a child. You know that it's unfair, uncivilized, cruel, and unusual punishment, and yet it's what the IRS does with almost every tax code. Tangent over, back to the book. Right when you finally made it to retirement, there's a looming uncertainty about how much of your own money will actually get to keep. That's why it's vital that Americans protect the assets they spend a lifetime building from excessive taxation. No single factor is more significant to your ability to live a lifestyle you've been saving for all of your life than to pass on your hard-earned savings to those that you love. Now, I envisioned getting through about 8 pages of this. Obviously, that's not going to happen, but here is something that is always interested me, and you'll hear me talk about the Fiduciary Focus. If you don't know what that is, make sure you find one of my videos, get it. It's a checklist that you should write down at the top of every financial decision that you make. But the bottom line is, when somebody comes into our office, I will write on a board the Fiduciary Focus, the 4 things that I make sure that I take into account in every financial decision. Risk and volatility, that's where most people are focused right now over the crazy volatility world. The second are taxes, or pardon me, our fees and expenses. What's it cost for me to make a decision? The third is taxes today and tomorrow. And last but not least is real return. Real simply means inflation in the financial world. And for years, people have laughed at me about putting that on the board. We're not laughing anymore, are we? Those are 4 things that you always have to be engaged in. And what's always interested me is that people will come in with their statements that haven't heard the show without bringing in their tax return, and they find it shocking that I won't have a meeting with them without their tax return. And they go, but I don't get it. Here's my statements. I've saved $1 million. I've got $1.8 million. I've got $400,000 in my account. Why won't you talk to me without a tax return? And the answer is, what happens on those statements is going to go up and down all the time. And you're trained to think about a difference in a 1 or 2% annualized return, because compound-wise, that makes a significant difference over the years. And believe me, 2% is huge. You know, I make sure when we charge fees to manage money that we're able to provide a service, not just in the return, but in your financial journey, that family focus process in all 5 of those areas. And if I don't think we're able to provide a journey that matches what it is you're paying, then we don't really want to have the responsibility. It's not fair for all concerned, to use a good old Rotary quotation. We want to make sure that we are providing value and we're being paid fairly and you are being charged fairly for the service that's being provided. You have to think about it that way. But nonetheless, we're looking at the returns, and you'll look at an 8% return versus a 7% return and extrapolate it over 30 years. That's a big difference, right? Let's say it's a 9% return and a 10% return differential after the fees and expenses. Well, that's a 10% difference. 10%. Goodness gracious, that's huge. It's not just 1%, it's a 10% difference. And so because you get statements in the mail all the time, and because people write articles about fees and expenses and how bad they are all the time without ever looking at the other side, and believe me, I don't want to pay any more money than I have to get a job done. So I'm with you on that side. But because those articles are written, people ignore the truth of reality, and that's that the tax plan actually has a lot more impact than the compounding return. Let me give you a for instance. Today in the United States tax code, in 2022, the tax rate is you get some money that's zero. You get to take off your standard deduction and some credits, itemized if you're able to itemize, and that makes sense, some credits. But you've got some money that's tax-free. For most of us, it's around $24,000 and some change. After that, you're going to be on this first step of the tax code, and that's going to be taxed at 10%. Once you go above a certain threshold, depending on whether you're married filing jointly or whether you're an individual, you're going to take another step up to a higher rate. It goes from 10% now to 12%. Now, folks, that's not a 2% jump. That's a 20% jump. And last I checked, the IRS is not in the business of returning that money. See, it's not like an investment account where the market goes up and the market goes down and it continues over a period of time, at least historically, to work from a lower left to a higher right. That's not what happens. You send the IRS a check, that 20% difference between 10 and 12 is gone. Ladies and gentlemen, in 2017, it was a 10% bracket that then went to 15. That is a 50% increase. 50. And it ceases to amaze me that people will come in and they will want to talk about the difference between a 6 and a 7% return, or a 9 and a 10% different return, or a 1% fee that they don't really understand what that fee is paying for sometimes, but they fail to recognize the impact on their tax return. Or they'll deal with a financial advisor who doesn't even ask to see their tax return. Now, folks, there's a lot of different vehicles you can use to get to that financial journey. A lot of different ways it can be done. My journey is to make sure that you're concentrating on your journey, your financial vision, and those 5 areas that we call the 5 critical elements: your life after work, the annual tax plan, the investment playbook, life happens, the good, bad, and ugly of life, and the legacy plan. We want to make sure that we're covering all of those and we're getting the financial journey. That's our way of doing it. We do not try to hit home runs and figure out how to buy the next company that goes up 300% and then down 300%. That is not our gig, right? We try to get on base, score runs, build net worth, act as fiduciaries where we treat your money as if it were our money and we were in the same situation. That's what, if you're doing this on your own, that's what you've got to do for you. Make these checklists, guys. I've done this for 35 years. It's all I've ever done professionally. If I make that checklist, you probably ought to be doing it too, right? Start with the fiduciary focus: risk and volatility, fees and expenses, taxes today and tomorrow, real return. Ask yourself, in this financial decision, have I thought about those 4 areas? What's the best way for me to be able to get it? Understand, in that tax planning, the IRS is going to change the rules as they come. It is, as Ed Slott put it, a tax bomb. I promise we'll continue to have these conversations. We're running out of time, ladies and gentlemen, but we'll get to them. Go to yourlifeafterwork.com. Get signed up for a Next Steps meeting. We look forward to meeting you soon. You have made some very hard decisions with your time. We make trade-offs every day. I could be golfing. I could be watching the show. I could be spending time with my kids or my grandkids. I could be eating here instead of there. Face it, ladies and gentlemen, most of you are at a period of time in your life where you can do just about anything you really want to do. You just can't do everything you want to do. It's a trade-off. You've got to make decisions, figure out what matters most to you. When you save $1 or when you spend $1, or when you pay down debt, or you put it into savings, or you buy and invest in a market. We make decisions all day long, and they all have trade-offs. Let us use our trademark proprietary system to help you make those decisions. Go to yourlifeafterwork.com. Get signed up for a Next Steps meeting. We'll give you things to consider today, things to consider in your future, and if we choose to partner together, what FEG will do for you, and we'll put it in writing. Have a great week. We'll see you next time.